Gary Saka on. Gary, are you there?
Gary, I'm here.
Perfect, Gary. And again, so apologies for my video not working right now. I'm going to try to get it fixed in the next hour. So Gary, can you introduce yourself and then also introduce the panelists? All right, thanks.
Okay, well, thank you. Actually, it doesn't look too bad. I'm seeing a picture of some Caribbean island there. So I'm Gary Saka. I'm honored to really moderate probably about the 6th or 8th panel from Marty. And today's topic is probably one that's on everybody's mind, Economic Outlook 2021. So we've got 5 panelists, and so we went on a pre-run. Hopefully everything will go okay here. We're going to start off with the first section of Economic Outlook. And what we're trying to do there is we want to discuss how the economic outlook affects your investment philosophy. So in order to get through this entire thing in an hour or so, we're going to ask each of the panelists to first go and introduce themselves and give maybe 1 to 2 minutes on their background and their website, if hopefully their LinkedIn is still working, and they go ahead and take a look at that, and then move on to that investment philosophy. So that gives you maybe 3 minutes or so, and then we'll go to the second round, which will be the new administration, and then we'll go into things like another round on interest rates and hedging and so on. So we'll go that way, and so I'm going to quickly introduce myself. I'm Gary Saka. I'm a board member of CAI International, stock symbol CAI. I've been there for 13 years. And before that, I spent a good deal of time as CFO or CEO of different companies in transportation, distribution, broker-dealer, biotech, and corporate venture capital. So I'm going to take them in the order of which I see them appear on the screen. So Kevin, why don't you go ahead first and kick off and give us some of your background and your view on the economic outlook.
My view on the economic outlook. So my background, lately I've been a chief investment officer in a multifamily office in Redwood City, managing north of 120 million. And having the particularity to doing direct in public, direct in venture capital as well. And then I was overseeing this fund selection on the private side. Across
Kevin, could you talk a little louder, please?
Yeah.
For the audience.
I'll try.
Thank you very much.
All right. So yeah, I'm Kevin Collas. I'm based in Pacifica. I lately worked with a family office called Ocean IQ Capital, where I was chief investment officer, managing their assets on the public side, doing fund selection, on the private side, cross hedge fund and private equity, and then doing and building their venture capital portfolio. So when I joined them, they already had like 13. Now they were at 20. The year has been pretty active, and 2019 too. And I recently left to concentrate on venture. I took a venture partner role in a fund called Ignite XL, which does seed and pre-seed consumer, which I really like. And I'm still working with Ocean IQ to do SPV. We're doing currently one on a late stage plant-based story, pre-IPO. And we're doing on a regular basic SPVs on A round or B round with Ocean IQ. And then I'm working on the creation of a fund for later. That would be like 2022 with the former head of M&A and venture of Adidas and a friend, CVC, with whom I already did a couple of deals with over the years, formerly at SAIC, Matrix Semiconductor, and Samsung Ventures. That's it. Next.
No. You want to just give a brief
I
economic
know,
outlook
say,
too,
yeah,
and
the
for
overview.
future ones, we'll shorten the bios down a bit because you can point to your website.
Yeah.
And
So the overview,
Sorry,
I mean, like
Kevin,
overview, me, I'm still
Kevin?
very nervous for this year, to be honest. I mean, there's an accumulation of things and it's not out of the way. Either on the health side, distribution has been very complicated, and the target of July for mass vaccination or this summer seems to be very optimistic to me. Even the ramp up of production seems to me very optimistic. So there will be a strange year with valuation that are pretty high across the board, and it's reflected by the precious metal evolution, by the Bitcoin evolution. People are nervous by still a huge amount of capital that is in negative interest rate. Yeah, so it's still prone to another correction, in my opinion. So I'm very cautious.
okay, then we have. I think we'll go on to Michael Ashley. Are you? Can you hear us? Okay, and why don't you give a brief background? Your point to your documents on the web, and then your economic outlook, and then how it
Sure.
influences your
Thanks,
investment.
Gary. Thanks, Gary. Yeah, happy. I'll try to be quick. Kevin, just a question. Are you supposed to be on the economic outlook today or the venture capital tomorrow?
No, I'm supposed to be on the venture capital tomorrow.
Yeah. So this is the economic outlook for today.
I just wanted to
Okay.
work to see how it was working, but I don't know how. I mean,
Okay.
I didn't know,
All
know,
right.
if everybody was in the call
Yeah.
or not. So I'm gonna take
Okay.
a call,
Thanks.
and I'll join you tomorrow.
Okay. Okay. Thanks.
Take care. Bye-bye.
Bye. Hi. Okay. So everyone, welcome to the Economic Outlook panel for 2021. I'm Michael Ashley Schulman. I'm CIO of the Wealth Management Boutique in the Manhattan Beach area. We've grown from January last year, we've grown from 5 people to 16 people, 210 million to 380 million, managing for high net worth. My last dozen years or so, I've been managing for a $2 billion firm down in Newport Beach, California. My economic outlook is mostly positive. There will be ups and downs. There'll be some volatility. We can get into that shortly. But mostly, I know this is a family office conference. I know family offices like their private investments. I've known so many family offices that just got out of equities and got out of the liquid markets in 2008, got out of them again in December 2018, maybe got out even more in March, and so many of them never just got back in. And so as much as we talk about illiquids, and they are very important to portfolios, I think, owning equities and being part of that uptake in equities is also important to portfolios, especially for the family office. Because you think of it, the family office especially can take a long-term view on the world and can ride out volatility. And I think too many family offices shy away from equities. Anyway, that's my intro. Next.
Okay,
And-
well, I can see there might be a reason for a wall because we got one person that wasn't in there, and I thought maybe Marty had let him in. So the other people that were on the call, as I quickly looked at the agenda, Axel, you've got some specific items that you have looked at before, and more of a alternative investment philosophy. So why don't you give us an introduction and how you see it?
Thanks, Gary. Welcome, everybody. This is Axel Merck, and I'm calling here from Palo Alto, my home. My other life is at our vineyard, where I'm escaping to kind of keep my sanity. As far as the business is concerned, we manage a little over $1 billion in a multifamily office / asset manager. We are probably best known for what we do on the precious metal side. We do both precious metals and gold mining. And And we have over 500 million these days in gold mining equities, including quasi private equity on the exploration side. So a little bit unique there. On the economic outlook side, we're known for the bears. That said, we've actually turned quite positive on risk assets. And we think that the reflationary efforts, both on the monetary and fiscal side, will push asset prices higher. And we urge our people to continue to emphasize different types of revenue streams, be that investments or otherwise, be that illiquid or liquid, because those correlations that currently move many things higher in parallel are going to break down at some point, and then you'll be glad that you've had it. And then on the risk management side, you want to be careful because a lot of people are using leverage in this environment. And as I don't expect something like what happened last March, but you want to be careful on that. But generally speaking, I have a positive outlook, but with a strong urging to look at uncorrelated assets to stomach volatility that may well come as and as other topics we'll touch on later in this discussion. Back to you, Gary.
Okay, well, that's great because we do have another section later on managing volatility. And of course, you saw Bitcoin go up, I don't know, 15%, go down 15% and up 15% in, just since the beginning of the year. So that'll be a good topic and could be a great guide to do that. Okay, so the next on the list is Ken Fryer. Are you on the call here?
Yes, I'm on. Thank you, Gary. And hello, everyone. My name is Ken Fryer. I'm joining you from Walnut Creek, California. I work for Secor Asset Management. That's an institutional consulting firm based in New York. We have about $40 billion of assets under management. My background before being in consulting is as a chief investment officer of large institutional plans. With respect to the economic outlook, I'm not that far from consensus with respect to the outlook for this year. But what I think is not recognized enough is that with the consensus expectation, the amount of economic activity in 2021 will get back to the amount of economic activity that we had in 2019. So we're basically just getting back to the level we were at 2 years ago. So if we think about getting to the same economy as 2 years ago, we're entering this situation with risk assets at extraordinarily higher prices than we had 2 years ago. If you look at the S&P 500, it's up almost 60% since the beginning of 2019. The world global equity is up about 50%. Russell 2000 has gone up by 60%, and the earnings have vanished. So there's no earnings whatsoever for small cap U.S. equities, and yet that index is up 60%. The NASDAQ has doubled in the last 2 years on the same earnings. So what we're seeing across the board is we've got the same economy coming up next year, but we have risk assets at exceptionally higher prices going into the year than they were at going into the same economy 2 years ago. So that leads me to be somewhat more concerned than I think Axel is about the prospects for risk assets going here. We know that there's an ongoing race between the rollout of the vaccine, which is not going that well in the US, only about 1% of US population per week. And at the same time, the growth of the disease, which is going pretty badly, unfortunately, in our state. So I think the economy is coming back. The other thing too that I think we should note is that the markets are looking past the downturn and the COVID problems now, but the markets should look past this upcoming year as well. We should recognize that the economy is really dependent upon government largesse for economic activity. And when that gets turned off, which ultimately it has to be turned off, then that will have an impact in the opposite direction.
Okay, well, thank you for that. And Marty, when I'm looking at this, we see various people in this room, but we see lots of people that are coming in and out that aren't on the call. So I don't see on my screen Cory Rita, but at least on the immediate screen. So Cory, are
Cory's
you
here.
there? And
That
can
should
you give
be,
your
that would be me
outlook?
right here.
Okay, good, good. There's probably 50 on my screen all over the place. So go ahead and give us your outlook.
So I'm Cory Rita, Chief Investment Officer with HK Wealth Management. We're a small RIA. I've been, my background is 16 years in the industry. I've been a fund manager since day one, came in under a friend of mine who was a 25-year veteran, and so came up with his team and then stepped out at Morgan Stanley and then left the broker-dealer world 3.5 years ago. So, I guess it's under the concept, build it and they will come. We run 10 different model funds as opposed to private placements or anything. We use, ETFs are the positions within each one of the model funds that we utilize. But, your prototypical conservative, moderate, aggressive, long, short, contrarian, and then, precious metals, Bitcoin, commodities, cannabis. We started those ones up last year, looking towards the newer areas of growth coming forward. As far as, and then I guess our area of specialty is, I always say invest for growth, but also protect from losses. And if we do that, returns take care of themselves. So that's where our specialty is, preserving client wealth and protecting their capital, because if we avoid the losses in the first place, we don't have to waste time making losses back. And hence, as a result, you tend to beat the markets. But, as far as where things are, look, central banks have been driving everything since 2009. Bad news is good and good news is good. No matter what happens out there, as long as the central bank spigots have been open, the markets have been powering higher. However, the markets were already in a massive bubble back in February. And all it was, totally disconnected from reality and economic fundamentals. And all it needed was a pin to come along and pop that bubble. That's what COVID was. Now, as a couple of the other panelists have already mentioned, we are, market cap to GDP, we're up to 190%. That's more than twice what we were in the dot-com bubble. So we're in an even bigger bubble today than we were back in February. And once again, it's going to be something out of left field, something that's unexpected that'll come along and pop the bubble. Or it could be nothing at all, like the dot-com bubble, when things just turned around, started heading in the other direction. But as far as, the disconnect between the economy and the stock markets, a positive economic situation could actually be net negative for assets, because if that, as Ken mentioned, as we start to pull back from the largesse of central banks and their support of the markets, tightening, less stimulus, whatever it is, then ultimately that's what the support has been for markets. So positive economic results could actually have a readjustment lower in asset prices. But that's why we do what we do with preserving client wealth and protecting their capital. So no matter what comes, I guess you could say I'm a fully invested bear.
Okay, well, that's great. And, we're gonna have a shot at, in terms of hedging a little bit later. And that will be great to do that. So Michelle Del Bruno, are you on the call here?
I am, except I accidentally clicked your link, so I appear as Gary also.
Well, I don't know. I actually got a lot more hair. I may actually do that for all my board meetings. That looks good.
So anyway, Michelle, I'm the CIO at Jordan Park. We manage in the mid-teens billions of assets. I should preface everything by saying that these are my own opinions and not those of my firm. We manage our assets in endowment style, typically long-term focus, with notable attention to taxes. About 2/3 of our capital is taxable, 1/3 is non-taxable. In terms of our outlook, I think long-term versus short-term, always important to think about the difference. Long-term fundamentals matter more. Short-term, I think we can largely ignore fundamentals, especially when we have all these policy actions underway. I should reflect, having looked and lived through the dot-com bubble and the great financial crisis, this looks like a recovery like any other recovery. In fact, If you look at the same number of days from the trough to today, this recovery has been almost identical to the one after the global financial crisis in percentage returns. So that's one thing to bear in mind. Two, in terms of near term, typically in a recovery, you see multiples fall, right? And you see earnings grow. And that trade-off often leads to the stock market doing better because earnings grow more than the multiple collapses. And so that's the real question to me, is what's going to happen to multiples, what's going to happen to earnings. If you look at earnings forecasts for the S&P 500, the consensus, which you should always take with a giant grain of salt, calls for $170, which is up roughly 30% from where we are here. So 30% increase in earnings can countenance a large fall in multiples and still have a positive equity market. If you instead look at the trend and having earnings revert back to the trend, which I think is a safer bet, a more conservative bet, it's still around $155 of earnings by the end of the year, which is a 20% increase, right? And then finally, lay on top of that the fact that the Fed has announced a new religion around combating deflation ever more strongly than before. Sorry, I couldn't hear that. The new combating deflation means that multiples may actually stay higher than before. If you in fact get a big increase in earnings and multiples staying where they are, you could have a market that's up 30% by the end of the year. That's short term. Long term, of course, deflationary forces dominate in this economy. And so you have to think about when that transition between short term and long term happens. And I think that's all about risk management. I'll leave it at that.
Okay, well, thank you, Michelle. This is going to be an entree to our next section, and that's the new administration. There's usually politics has three things that people want from politics. The first one is they want stuff, and President Biden on Thursday, or President-elect Biden on Thursday, will outline spending trillions of dollars, as he says, to invest in the deficit. And I guess we have to wait to see. And from a historical standpoint, between the Civil War, 1860 and 1900, the United States had a tremendous amount of deficit spending financed by European investors. But what did they do there? They built roads, they built railroads, steel mills, and really catapulted the United States into a leading world power. So the question is, will that be spent on productive items, or will it be on things that don't contribute that much to the economy? So we'll see that. The second issue is really regulatory and more what I might call cultural warriors. And that goes into things like, how much regulations there'll be, put back on things like the oil and gas industry, or how will they go into the Green New Deal, or buy 50 million solar roofs. That's the second thing. And the third thing is really, I don't want to use the word revenge politics, but it might be, and you're seeing that this week. So that's something that there was a article that all the compression, there'll be a compression in multiples of people like Facebook, on Amazon Web Services, maybe even Deutsche Bank now. So will you enforce compliance by simply getting people off a public forum? That's a little touchy, but it's something that we probably have to look at. So in terms of comments on all three in the amount of time you wish to devote to it, I'll go ahead in the same order with Michael Schulman, and I wanted to point out one thing, since we used it as kind of getting some of our choices. He's got an excellent article on LinkedIn called New Year, New Decade, and Roaring 20s. So go ahead, Michael.
Gary, thank you. Thank you for the introduction and mention about the article. There are a lot of questions there. I'm not going to touch on all of them. I am going to touch a little bit on Biden, and I think the newly elected President Biden will pass all sorts of legislation through the Senate chamber, even without a 60 majority. just as Trump lowered corporate taxes with bare minimum of a majority, I think Biden can increase them. And just as Obama passed Obamacare with a bare minimum of a majority, I think Biden's going to be able to build on it. And most relevant for investors, I think Biden can use the Senate reconciliation process and the slim 50-50 tie with Kamala Harris as the tiebreaker to raise capital gains taxes. So that's kind of the tax side. I think the parties have an interest, unless you're in Italy, most political parties have an interest in staying in power. And I think the Democrats have a strong interest in staying in power. They see probably that the nation really is split. The Republicans are not a minority. Elections were close and Republicans won a lot of the governorships and state houses. So I think what the Democrats will do is they'll try to stimulate. And they, as Biden said, the first stimulus package now in December, the $600 a month, $600 checks, that's just going to be a down payment on stimulus. So I think there's going to be a lot of expenditure going to the consumer, which will help the economy. And I think after, a decade of both parties and both sides of the US talking about it, I think some infrastructure spending will take place. And I believe that Biden will be supportive of the states and municipalities. So I see a lot of positive economic thrusters coming fiscally and monetarily to help consumers, to help businesses, to help infrastructure, to help states. Will there be volatility in asset prices? Yes, but with this tsunami of money coming, it lifted us in 2020. I think that's going to keep coming and going through in 2021.
Hey, Gary, Marty Sakata, can you hear me?
Yeah, I can hear you.
Great. So, and I hope that you can see me as well. But
I can see you.
Perfect. Excellent. So the poll results came in for what people want to talk about for this panel, or at least some of the issues. But, the number one was relaunching the economy past post-COVID. Number two was just a general, how are we going to get through COVID-19 process? And then the third one is asset bubbles, just for the speakers' edification, so they know what's on the audience's mind. So relaunching the economy post-COVID, maintaining the economy through COVID, and then asset bubbles.
Okay, so we actually have those later on. After this one, we are going to go on. There's going to be we have, as I said, we're going to do the dollar trade later. We're going to do hedges, and we're going to do asset bubbles. So we're going to get to all those. We've got those actually on that thing. Unfortunately, it's hard to both concentrate on the discussions as well as look at the.
That's why I'm telling you.
That's a chat. Yeah, so that's great. Okay, so Axel will go on to your view there, and I think because of the pandemic, to the extent that it affects your viewpoint, we'll want to see the vaccine, and I think as of a couple of days ago, 15 million doses had been shipped to the states, and something like 5 million had been actually people had gotten the first shot. So the issue is not in production or distribution, it's that at the local level. And there's a big variance in terms of the states, in terms of the level that they've been able to utilize everything they've got. So that's going to be an important thing. And in terms of that, the other thing that's going to be very important is how many people are going to take the virus, take the vaccine. Yeah, I don't think you want to take any vaccine, take any virus, but to take the vaccine. And we've looked at something like 60% of the people that want to take the vaccine. Now, maybe that will change over time, but there's a lot of pre-election jockeying about whether this could be developed and stuff. And now all of a sudden the guys that said the vaccine was no good were first in line to get it. So why don't we incorporate that comment in this discussion then on the Biden administration, and will he be successful in not so much pushing it out to the states, but also to actually get people to at the local level to be able to give the shots and get enough compliance to make herd immunity, whatever that may be.
Can I also add one comment to that, which is that there was definitely a change of tenor from Andrew Cuomo yesterday, where he's saying everybody must take the vaccine because New York has to get restarted. So, that's, I think there's a change of tenor. Axel?
Yes, sure. Let me just take a few hours to address all of these points. So, I think one of the first things I said in March is we should spend trillions of dollars trying to reopen the economy, and I'm glad that 9 months later Cuomo is finally thinking of that. Obviously, I'm very much in favor of doing it safely, but what we see, and that these comments are obviously supporting that, we're limping along, things aren't working as effectively. To kind of get to the essence here of the panel, I think that starting late March, vaccine tourism is going to ramp up substantially. People will have deference to the healthcare workers and the elderly, but at some point, those who really want to get the vaccine will find a way of getting it, travel to another state, to another country, Israel, or wherever it may be, to do that. And the implication for the economy and possibly the markets may be that, first of all, we've seen that the market is a discounting mechanism. But if any of you have friends who have had COVID and have gotten through it, I think the one thing they have is an urge to travel. So I have a colleague who had COVID, his entire family had COVID. The first thing they do is they book a trip to Mexico. And so similarly, once you have the vaccine, you probably feel like you want to engage in things, you want to spend money in different ways. And so that's going to be a transformation. Bridging over here to kind of what this all means here on the policy side. Since we all have a crystal ball and know exactly what's going to happen, let me just defer here to a market indicator I encourage everybody to watch, which is the 10-year yield. When just before the Georgia runoff elections, where the 10-year yield was hovering in the mid 80s up to about 90 basis points, and then it has moved up substantially. The yields have gone up substantially, and the reason is, I think, because by having a Senate majority, even if it's a slim one, the odds of passing more things are increasing, the odds of spending more money are increasing. And that's really where I see much of the theme. Gary mentioned that Michael has this theme on LinkedIn about the roaring 20s. I think that's very much something that is quite likely going to happen. Now, keep in mind, the roaring 20s didn't end so well. And the question really is, when is that point going to come? I think most in the audience are old enough to remember Greenspan warning in years before the bubble burst that we are going to pop a bubble, and that this is irrational exuberance. And so similarly, when we see some evaluations, of course, they're stretched. But if you look at what this all means when you reflate, and we have a globally synced reflation, right? One of the things it means, by the way, for asset allocators is that they're going to rebalance their portfolio. For years, the US was the preferred place to put your money for many reasons. And now, as the quote unquote rest of the world is doing better, emerging markets are picking up, the Chinese stocks are breaking out, lots and lots of other things are happening. And so my view is that you want to take this time to really stress test your portfolio for rougher times ahead. I'm not predicting they're coming tomorrow. They will eventually happen. And then one more point. We're now thinking that $1 trillion is nothing anymore. The Fed is going to be there to support us all the way. And we have Yellen at the Treasury, who is obviously a Fed mindset. And so we will see things that, she's a labor economist, by the way, so we'll see policies that go directly to the people, more unemployment benefits. A tax cut that Trump had doesn't impact the kind of the common man quite as directly as infrastructure spending, direct payments to people. So, and similarly, I don't think there's going to be a waiver of student loan debt, that sort of thing. That doesn't have as much of a direct impact. All of that may be inflationary. And one other reason to look at the 10-year yield, the Fed is promising to keep rates at zero, but economy is going to pick up. That means real interest rates are going to decline further. And obviously, as the 10 years is rising in yield, that may provide competition to risk assets. But as this financial repression is, if anything, accelerating, we will see lots of other implications. And as I indicated earlier, we do things on the precious metal side, so you can imagine that has implications there as well. But I'll pause here and not take up the next 10 hours on.
Hey, Axel, I just wanted to quickly intervene here because so we know that in 2008 there was $1 trillion deficit, And now this year there'll be a $4 trillion deficit, right? So, and then Obama spent $1 trillion a year deficit wise. So should we expect a $4 trillion a year deficit for the next 4 years?
Well, what we can expect is unsustainable deficits, right? And the question what's going to happen, and obviously as long as the rates are low, nothing is going to happen. But we have a Fed that all but promises not to be thinking about inflation, which means we will have inflation go above 2% before they'll do something more serious. And it's just going to be a very unstable environment. Because of the leverage in the economy, of course, when they raise rates, it's going to kind of probably put the economy into a tailspin. And so this is going to create a very unstable dynamic, if nothing else.
But inflation is well over 2% for things you need.
Well, obviously,
education, healthcare, housing, right?
And we'll see amazing base effects this springtime. This year is going to be all over with financial metrics. And one thing I urge anybody is to have a process for the investments, because if you just kind of listen to the news, you're going to be completely confused.
Yeah, so Marty, you're taking into the topic after this one, the Biden administration, but I think Axel does kind of, and I'll respond to Axel in the next thing, but essentially to say, Jeffrey Gunlock of Doubletree quoted one of the Federal Reserve members, Charlie Evans, saying we're in it to win it, and that is that they would, increase both short and long-term inflation higher than the yield curve along the entire yield curve. And so what you'll see is it's cheaper to borrow on a mortgage than interest rates. It's cheaper to borrow short-term. And so that is the thing. And I think Axel has a point to talk about, and that is that the roaring 20s didn't end up so well. So we may find a point where Donald Trump really was right when he said we got to restructure our debt, and we'll restructure it, I think, with this inflation. How it ends up, I don't know. I've got a friend up the hill, and he's a Portuguese guy. He says, Gary, the best investment today is the Brazilian real. It's going up like crazy. Well, Bitcoin going up a little bit more, but he's investing in that. So we may find in the emerging markets better opportunities, and we'll talk in the next section on that. But let's get back here. Ken, why don't you give us your economic outlook and in the Biden administration, how you think that will affect that?
Right. Well, there sure is a lot to talk about here. Yeah, I think on the topic of deficits, the comment that you just mentioned, Gary, about another comment from Charles Evans, the head of the Federal Reserve Bank of Chicago, I think it is important. He said that he's talking about 3% inflation being no problem for the Federal Reserve. I think that's the first time someone from the Fed has said that. The target of 2% is probably not a target, it's probably a floor, and the Fed is going for something higher than that. If that's the case, then what does that mean for the capacity of the US government to continue to have enormous budget deficits? What does that mean for price earnings ratios? So many people dismiss the enormous price earnings ratios, which is infinite for the Russell 2000 today. They say, well, let's not worry about that because we can justify it because interest rates are so low. Well, if the Fed doesn't really care that much about inflation and is trying to get it to be 3%, then they'll hold down the short end. So we'll have negative real rates for some time. But can they hold down the long end? If we look at government spending last year, it was really at World War II kind of levels. And if we look back at, well, what happened when the US government went from having deficits in World War II to cutting them back, well, the US went into recession. The S&P 500 fell by 40% right after World War II because the government stopped spending so much money. So I think I agree with what Axel said. And I mean, it's just obvious that this level of government spending is not sustainable. And so that we've got a fiscal stimulus now, but the flip side of that is the fiscal drag. So I'm concerned about that and its implications on asset prices. I'm certainly not an authority on vaccines and such. I think there's a legal issue with respect to vaccines that's going to hamper us in the US. the manufacturers of the vaccine have legal immunity, the distributors have legal immunity, the person that puts the vaccine in your arm has legal immunity. But right now, if your employer tells you, hey, you've got to get your vaccine to work here, to come to the office, well, the employer doesn't have legal immunity. The employer can't make you take the vaccine. And we do, as Gary mentioned, there are people that are uneasy about taking it. So I think unless employers have immunity also and can require people to take the vaccine, it's going to have a kind of mixed take up. So anyway, I'll leave it at that.
Hey, Ken, there's also a lot of conjecture because right now they're saying that they want to just use every vaccine that's out there and give it to anybody they can without thinking about the follow-up vaccine that's required. I live with a doctor, and she's told me that there's no proof the vaccine is effective with only one shot. That you really need 2 shots over a 6-week period to be able to go back into the office and feel safe.
Yeah, that's a big thing. And I got one guy who actually went across the border, to another state and found out that you don't have to prove residence in that state, nor do you actually have to show that you're a citizen of the United States. And so he went to a red state from a blue state, and he actually got his vaccine. He's happy as a lark. He's actually going to go back there
Right.
again, and just the vaccine. So yeah, that is that. We don't want to. That's really not a consideration. Yeah. Let's move on then to Cory. Let's get your views on all these subjects.
Well, so many to touch on. It's kind of hard to try and keep track of where we're supposed to be. But
yeah.
Before
really
Trump,
Biden administration, right. And the rollout of the vaccines and stuff, and we'll get to the interest rates and stuff in the next segment.
Yes, I mean, government policies and such. Look, before Trump was elected, he said that the market was in a massive bubble and it was going to come crashing down, and then he won. So then he had to keep the bubble inflated, and they pushed the bubble to even bigger proportions. And now Democrats have won, and now Biden's inherited the current structure out there. So they've got to continue to do everything they can to keep the bubble inflated and not let it crash on their watch. But, we've just, national debt went from 10 trillion when Obama came in to 20 trillion when Trump took over. Then it went to 28 trillion. This has just been a complete accumulation of more and more debt. And I mean, when you take debt out of the equation, we had 0 economic growth. This has all been debt-based finance and economic growth as a result of that. But corporations doing the same. Axel got his wish in March when they did 3 trillion of Federal Reserve stimulus, another 4 to 4.5 of fiscal stimulus from the government. And so I expect all those policies just to continue because that's all they have left. They have to do whatever it takes to try and keep the bubble inflated. So there will be more deficits. There will be more fiscal stimulus coming from the government, more unemployment benefits, above and beyond what people were making before. People are making more money now than what they were when they're actually working their jobs. So more stimulus checks coming, and what else can they do at this point? It'll be more of the same because they've sort of been whittled down to a one-trick pony. Print more money, issue more debt, buy bonds directly in the markets. I mean, the Federal Reserve is still pumping $120 billion a month into the markets as we speak. So, the government, the Federal Reserve, it's going to be more of the same.
Okay, well, Cory, thanks for that. Michelle, you're up next.
Hi, everyone. Lots of different thoughts here. Again, echoing what others are saying. I think, first, the vaccine. So the Pfizer one was approved on December 11. I think Moderna on December 18. There's been roughly 6 million doses distributed in roughly a month. That's 2% of the population in the first month. If you look at various papers that have simulated what that implies, a 2% rollout implies that infection or case rates will fall back to the October levels sometime late summer, early fall at a 2%-ish rate, accelerating to 4 or 5 over time. So that gives you a feel for when things will get back to the pre-spike. These mRNA vaccines are quite easy to tweak. So if there's a new variant that comes out that needs to be taken care of. I don't think that's going to be a problem as of yet, including both the South African and British variants that are out there. So enough on the vaccine. I'm not an epidemiologist. In terms of other numbers that are interesting, I like to be very analytical if I can be. There's $1.5 trillion of excess savings in the economy, excess being over the long-term sort of average. It's of course distributed more in the higher income households, but nonetheless, even the low income households have significant bank balances relative to their own history. So I think there's a lot of pent up demand already without any further stimulus that will unfurl on the economy, be unleashed on the economy. And so that's what supports those earnings growth forecasts that I discussed earlier, plus 20, plus 30% earnings, which ultimately is what's going to drive the market. In terms of inflation, again, I think people underappreciate the Fed's new religion. They've talked, and to echo some of the stuff Ken said, they've talked in a way, spoken in a way they never have before. If you're averaging 2% over a cycle, we just finished the year at 1.4. So that means if your cycle is only 2 years, you need 2.6 on average for 2021 to get to 2, right? So I think people have not internalized that. They've also spoken about using monetary policy for improving inequality, a new thing as well. All policy was always done based on national averages, national average inflation, national unemployment numbers. If instead you focus on the poorer states that have more difficulties, and you look back at prior rate hikes and wait for them to be under full employment and 2% inflation, you actually never would have had a hiking cycle in history, because the 4 or 5 poor states have never achieved full employment and full inflation target. So that's another wild card. How does the Fed navigate that while not letting the market, the equity market, explode with multiples collapsing? They've already talked about it, yield curve control. It's what the Japanese do. They've just announced where they would keep the JGB at, and they buy and sell accordingly. So if the 10-year Treasury starts being at 2.5%, and the equity market's falling apart, they're going to announce yield curve control, which instead of giving quantitative targets for buying treasuries, will instead put a price target on the 10-year, call it 1.5, and they will buy and sell to control that part of the yield curve too. They've already talked about it. There was speculation a few Fed meetings ago that they would actually announce it. It surprised people that they didn't. But to me, it's a logical next step in trying to square the circle, if you will, of letting inflation run, but not letting asset markets collapse. So I'll stop there.
Okay, well, thank you for all those comments. The next subject is really something that Axo turned on, so we'll run through the rest of the panelists on interest rates and the dollar, and how that's going to attract trade flows and manufacturing in the United States, and then we'll get to the hedges and the alternative assets, which I'm sure a lot of you people are coming here. So in terms of the dollar, the Dixie index over a long term, kind of similar to the euro, has gone from maybe 80 to 120. When in mid-December, Citibank said, hey, we think that dollar could drop 20%. It's gone down from 95 to 90. Maybe it's down in the 80s after Biden talks about his deficit spending, because they do have consequences. So we'll have to see how that is. But why don't we touch briefly, and I'm going to exclude, first of all, let's go ahead with Michael. Why don't we talk briefly on that so we can get to the one that a lot of people have interest in terms of alternative assets and hedges.
Sure. Thanks, Gary. I'll try to be quick. The dollars since, February, March disaster of last year, the dollar has lost a lot of strength. If you look at it against the Canadian dollar or other currencies, the dollar has already declined a lot. It seems to be right now in the middle of its long-term range. Could it decline a little bit more? Yeah, maybe, because we tend to be right now financially a little bit more loose than our European and Japanese friends, although every country right now has a loose fiscal and monetary policy. Ours just seems to be a little bit more generous. So yeah, I think there's room for the dollar to weaken a little bit, but I don't see it being disastrous. And you know, I think there'll be growth in emerging markets. I think our multinational companies, European multinationals, but especially American multinationals, will benefit from that emerging market growth because a lot of their growth and earnings come from emerging markets, and that could get translated back into better earnings through a weaker dollar. So that's my quick outlook. Next.
Okay, Axel wanted to get a quick word in. I actually was lucky that I just looked down at the chat to find it. So Axel, why don't you, make your comment here
Yes.
before we go on to the next person?
I think we reached the secular turning point in the dollar. The dollar was in a secular bull market for an extended period until March. As we've reached the reflationary phase, we are in a secular bear market for the dollar. And if there's one thing the dollar is these days correlated to is risk on, risk off. Historically, the yen fulfilled that role. It's not acting in that capacity these days. And so right now, when risk is on, when equity market's going higher, then the dollar is weakening, and when there's a quote unquote flight to quality, the dollar is rising. And the reason is, of course, that as we reflate the world, people are borrowing around the world. They tend to borrow disproportionately in US dollars, and so when that volatility goes up, they have to delever, and that helps the dollar. And then of course there are lots of micro things that are going to happen in this world. But and the euro is actually not my favorite currency these days, because we think that the money printing machine there is going to be in full speed. But overall, yes, we are quite dollar bearish over the coming years.
Okay, and so my Aussie colleague, a Harvard Business School colleague, one time wrote me, he says, it took us 30 or 40 years to get the Aussie dollar par with the US dollar. So we may in fact see that in the Canadian dollar again at par if the commodities are so strong, would you say? Axel?
Well, Australia, of course, has an issue with China these days, and they're picking a fight there. And so those are currencies that they are very sensitive to trade. And it's more emerging markets in general are going to benefit in this reflationary world. Australia has some challenges there with Australia. I would just leave it at that for now.
Okay, let's go on to Ken. A quick comment on that before we move on to the next subject.
Yeah, no, we're almost out of time. I'm not as much of an expert as Axel is on currencies. It does seem that since the Federal Reserve is both quite willing and quite able to create dollars at an even a bigger pace than the other central banks, and they're going to continue financial repression, maintaining short-term interest rates for the US dollar at well below the rate of inflation, then that means it's not necessarily good for the value of the dollar. I'd have an interest in looking at emerging market currencies as potential to appreciate relative to the dollar going forward, because you get both a better nominal and better real return from them. I'll leave it there.
Okay, Cory.
There's about 5 or 10 minutes left, Gary, so you're good to go. But
yeah, I thought I had till 10:15. I was managing till 10:15 based on the schedule.
But I did want to. I think the schedule was changed to 10. But what I did want to find out about the. So we all know MicroStrategy moved part of its treasury into Bitcoin in August, and it's put more than $1 billion into Bitcoin. And if treasuries around the U.S. start doing something like that, how does it bode for the dollar? Just to kind of get you guys into the alternative discussion.
Okay, well, we'll probably need till 10:15 to get to everybody. If you can extend it a little bit there. Why don't we go?
10:10. I can do 10:10.
Okay, we'll do 10:10. Cory, why? I guess in this round we'll comment on the dollar, but also let's take you as then also the leadoff person in terms of alternative assets, both hedged and non-hedged, correlated and non-correlated. There's a separate issue on things like SPACs and Bitcoin later on, but why don't you comment on what you would advise, and especially in terms of managing that volatility where you see something like Bitcoin that can have 10 or 15% or even 20% drops in a day. So, and maybe what your percentage of allocation you'd put in those.
Right. So I mentioned that I started up the cannabis, the commodity, the precious metals, and the Bitcoin funds last year in June and November. And this was all predicated for new areas of growth moving forward and a weaker US dollar, which is what we've already seen. I mean, commodities are up 40%. Sorry, the cannabis funds up 40%. Commodities are up over 20, just over 2 months. Bitcoin, since we started at June 1st, is up, through Friday of last week, was up 240%. But you have Bitcoin is now being transacted on PayPal. So real world business transactions are occurring. You've got these companies dropping corporate cash into buying Bitcoin on their corporate balance sheets. You've got the big institutional players that are getting into the space as well. So, and overall, there's a stock to flow modeling chart out there that talks about the halvening cycles and longer term growth projections and such. And that's projecting to be at 100,000 in the second half of this year, if it holds true as it has in the past. So you've even got the big Wall Street firms that are jumping on board with the Bitcoin phase. But I mean, as far as with what we do, I mean, we have an underlying risk mitigation strategy, and yet we buy low, sell high. It's old school meat, potatoes investing. So when we hit our buy and sell triggers on these, not just Bitcoin, but on any of these alternative asset classes, we'll sell and move to cash and avoid the next drawdown, get back in, catch the next run up. So it's just, that's how the strategy runs that for what we do. I'll leave it there. I'll keep it short. I mean, everyone has to get on before we
Okay, okay. Michelle, let's go ahead, and any comments on the dollar and also how you view the alternative assets and what your allocation would be to those things.
Yep. So a dollar briefly. I used to run a fairly large FX book, so I like to talk about the dollar. The dollar, first of all, I would argue that the better index to use is the trade weighted index, not the Dixie, because it reflects actual trade flows and volumes. The US trade weighted dollar is down about 3% on a trailing 12-month basis. You've got to sort of remember that the big run up in the dollar was a flight to quality type thing, and that's whittled itself down as people have calmed down. So I wouldn't sort of look at the near term and think more long term. Down 3%. Can it go down another 3 or 4%? Sure. Can it go down a lot more than that? I think that starts causing problems for example, EM and other places in the world. So the dollar, is co-integrated, is the technical term, with other currencies, so with other major currencies. So it can swing around some from the big major currencies, but not a whole lot, in my opinion, before it attracts a coordinated intervention. In terms of alternatives, the holy grails to look for uncorrelated assets. Fixed income, long dated treasuries still behaved uncorrelated or negatively correlated actually during the crisis. But there's a question now whether they can do that anymore because the yield is so low. But if you look at what happened in Europe, yields went negative. So I think they're still useful for tail scenarios as a hedge. But otherwise, you're going to have to find in your traditional 60-40 or 70-30 type portfolio, you're going to have to find something else to fill that sort of negative or flat correlation type thing. And so obviously, alternatives are a very big part of that. I think in particular, real assets. We recently, or I shouldn't say that because I'm not allowed to talk about our own thing, but I think what's interesting is farmland. Some types of real estate could be interesting. All of these things always being done carefully in terms of not giving all the money away to managers. Third-party managers are still charging what they used to, even though expected returns are down. So I think a good strategy is to JV directly with providers in that space. Private equity, and venture, everyone's excited about venture now again, but need I remind you that for about 10 years, no one was talking about venture. So, a lot of people showing huge unrealized marks in their books in venture, much like they were in 98, 99, whether those things translate into actual realized returns. I think part of the reason why SPACs and direct listings are so popular, becoming more popular, is because people are anxious to try to convert these things into realized gains as quickly as possible. If they don't, who knows what will happen. I'll leave it at that.
Okay, we're going to move on since we got a few minutes cut off there. Michael, Let's go ahead and get your comments then, especially on alternative assets now, because time is short.
Sure, happy to chime in. So, quickly on Bitcoin, it's definitely an alternative. I tend to think of most alternatives as being illiquid. I like to define them as that. I'd say Bitcoin is the one alternative to that because it's definitely extremely liquid, although extremely volatile. I'd say there's something interesting with Bitcoin. If one person owned all the Bitcoin in the world, I think it would be worthless because there'd be no way to judge the value. As more people own and buy Bitcoin, I think there's a network effect. It's kind of like if you have the only telephone in the world, there's no one to call, it's worthless. But if 1 billion people have a telephone, then the telephone's really valuable. I think it's similar with Bitcoin. There's a network effect. The more people that own it, the more value there will be. That's my little bit on Bitcoin. As far as alternatives, we've done a couple credit funds last year, coming right out of the crisis. Got our clients into some credit funds. We've done some real estate deals. There's a lot of room in credit funds where you can hopefully get some equity-like returns, but be much higher up in the capital structure, be senior, covenant heavy in the capital structure, a little bit safer, a little bit less volatile. So we like the credit area, the distressed credit. There's a wide range of credit, so be picky with your manager and your covenants. We do like real estate. Again, there's a wide range of real estate and real estate opportunity. But we think there is room there in some of the industrials and the warehouses. We don't want to get too loaded up on that because I know that's a hot area now. Hotels definitely will come back. So, there's areas for opportunity. Next.
Okay, well, we've already heard a bit of it from Axel, but I'll let him go briefly and then we'll follow up and finalize it with Ken. So Axel, you've got some ideas and your website has a tremendous amount of things to read if people look at that.
So just a few points. We run a portable FX strategy. We love it. It's completely uncorrelated to anything, but it's completely unpopular. Nobody wants to touch it because it's too idiosyncratic, I suppose, for most. Where we do see an interest is obviously in the traditional diversifier gold, but where we see particular interest is on the gold mining side. And the reason is, in my view, it's an extremely volatile space. And that means with a fairly small allocation, you can get quite some diversification to portfolio. I'm not trying to tout it, just saying what I see in the markets. And then the other alternative, that the illiquid alternative that I personally engage, I mentioned in the outset of this call, we're developing a vineyard. And that's the sort of thing, I'm not suggesting everybody should jump in and develop a vineyard, but developing additional revenue streams, anybody who has the means to that, I'd encourage them to consider it because that provides one, it's the free lunch on Wall Street is diversification. And you don't just have to do it in equities, you can do that outside of liquid assets as well. Back to you, Gary.
Okay, so then we have Ken, and unless I missed somebody else, we've gone through this whole topic. So Ken, why don't we have the final word then on alternative investments?
Sure. I think there's a general consensus in the panel that we should worry about inflation, or at least that we have a fairly dovish Fed now, and they won't mind if inflation becomes higher. And therefore, as investors, we should think about real assets. And so I like a lot of the things that Michael talked about. I think high quality real estate makes sense to do. I also think, as Michael said, that having a play in distress makes sense. I think there's a real possibility that the economy hits an air pocket in this interim between while the vaccine is going out and the disease is still a problem, we could backtrack some. And if you saw the statistics that came out today from MFIB about the small business situation, it's fairly negative. It's much worse than last month. And so I definitely would want to have a distressed play. So high quality asset backed kinds of investments, defensive sorts of investments. Now, I also think equities are in essence a real asset. I'm concerned that they're overvalued now, but over the long term, equities tend to hold their value against inflation. One last word about on Bitcoin. I think I could create a Ken coin that would have all the properties that Bitcoin has. I mean, the arguments that people make for Bitcoin are the same arguments that people make for gold, that it's hard to make new supply relative to the existing supply, and it will hold its value as central banks debase the value of currencies. But there's a lot of things, like Michael said, that have similar qualities, but are much better investments, such as farmland or commercial real estate or hotels, et cetera. So there's a great book that was written in the 1840s called Extraordinary Popular Delusions and the Madness of Crowds. So I think there's at least some probability that when new chapters of that book are written, that Bitcoin will have a place.
Okay, well, thank you for that, and thank you for that closing comment on the 1840 book. I've got it in my bookcase. Somewhere here, I've actually got 3 bookcases in here. So, well, this has been a great panel. We probably could go for another hour. In fact, if Marty runs out of time, maybe we do it tomorrow again. There's lots of people. Hopefully, all his panels will go successfully. So, thank you for everybody here.
Thanks, everyone.
What's that?
Have a great day.
Yeah, thanks for everybody. And I guess we go on to the next one. We've enjoyed it. If you liked it, I'll be at the last panel on tomorrow, on Wednesday. So thanks for everybody.
Great. Great job, guys. Thanks so much.